Hello everyone and welcome to your on-chain update for the last day of January. What we're going to look at today is derivatives, leverage and short squeezes. We're going to do a bit of a snapshot overview of the perpetual swap market, and then we're going to dive in and have a look at a little bit at the short squeeze that certainly accompanied what happened over recent months, kind of supporting the rally that we've seen, but then also looking a little bit ahead and saying, well, okay, what is the directionality? Because as we know, a lot of people, if you're getting short squeezes, and this typically happens in late stage bear markets, the reason you get these short squeezes is effectively the market is betting in the wrong direction. You have too many people who are saying we're going to 10K. And we saw this in both on-chain data and we saw it in derivatives markets. You essentially get this complete flush out. The markets are in backwardation, and essentially everybody's capitulated out. And at that point in time, you essentially exhausted sellers, and a bounce to the upside is then the move. Now, what typically happens is the market gets a little bit excited. It goes, oh, look, the bull market's back. And the higher the price goes, the more that thesis gets confirmed. And then eventually you're going to get some people leaning in the wrong direction at the same time, but in the, going too long and the thing starts to pull back. So now that we're in a rally, the kind of thing that I like to do is essentially take the other side. So, okay, what is going to put the top in on this rally? And derivatives and leverage is certainly going to be a part of it. So I just want to explore it in a bit of detail and see where it takes us. Let's get into it. Okay, so as I mentioned, we're going to start with the perpetual swap market. And the reason why is this is essentially the dominant market in this space. Perpetual swaps being essentially futures contracts that do not expire. They manage to tick on indefinitely, and they use funding rates to essentially keep things in line. So the funding rate is essentially like an interest rate that people pay in order to take on the privilege of having that leverage. And what you end up there is in order to pay that funding rate, those who are on the other side of the trade, the market makers, are essentially incentivized to get paid to build liquidity. If the market is net long, they get paid to build up short side liquidity and bring the price back towards the spot index. Now, it's pretty dynamic when it comes to looking at leverage. It is a challenging system. Things are constantly evolving. The two charts that I think really matter. So the first one is up the top here. This is BTC is on the left, Ethereum on the right. When you're looking at open interests, as you can see, it kind of moves very, very similar to the price chart. So in many instances, it's quite hard to see. You can see like the notional USD volume that is open. But I actually prefer to look at these things when it comes to derivative markets in particular on the BTC and ETH denomination. And what this does, it removes coin price from the equation. So if someone's opened a 1 BTC long position, that's 1 BTC worth of leverage. And it's going to essentially scale relative to market size. Or essentially, if they don't close any of that position out, it will stay 1 BTC relative to the Bitcoin market cap. So by removing coin price, we can actually look at growth rates. Now, we saw a huge amount of relative leverage building up during the downtrend. So when I say relative leverage, the reason why this is called relative leverage is what you're seeing is there is an increase in the amount of BTC denominated leverage. But if on one hand the market was, because we're basically comparing this to the market cap. So when you have the market cap falling, it is easier to add on a single Bitcoin position, right? It's easier to put on, 1 BTC worth of position at 16,000 compared to 30,000, for example. It's literally, not quite 50%. It's twice as easy thereabouts. So what we're looking at here is both a kind of over time, the amount of BTC positioning got larger. This is kind of right before, note the peak leverage was right before FTX imploded. We saw as price was falling, more and more people were opening up short positions. There was kind of this uptrend. This is both a combination of people going short, but it was simultaneously people who were essentially putting on the same dollar size position for more BTC in relative scale. Then FTX happened and wiped out for both BTC and ETH, wiped out just a huge amount. I did the calcs the other day. There was about 200,000 BTC worth of open interest that has been closed out, noting that we are all within the same price range. So this is all kind of relative scale, comparable. We saw about 200,000 BTC worth of open interest get wiped out. 95% of that was associated with FTX. So huge amount is primarily due to FTX leverage going to actual zero. But you can see that overall, this trend is down. We are seeing less open interest relative to market size on both of the majors. So it's kind of interesting that we're actually seeing leverage flowing out of the system at this point in time. In terms of the overall perpetual open interest dominance, this is comparing the dominance of BTC and ETH. We've covered this before, but isn't it interesting how they go through these kind of pockets where the dominance closes up, meaning there's not as much, but approximately similar, 55 versus 45% of the open interest is BTC and ETH, and then they widen out again, and then they close back in again, and then they widen out again. So we kind of spoke about this, I think it was right before Christmas, but looking at this liquidity profile that moves between the two majors, there's sufficient liquidity on both sides of these assets that really the market does in fact trade these things in these cyclical bounces, which is quite interesting. But we are really starting to see it play out quite consistently at the moment. But as you can see, Bitcoin dominance is trending up slightly. So we're going through a bit of a Bitcoin dominance phase. And I strongly suspect it will converge back at some point and we'll go back towards an Ethereum and probably an altcoin dominated phase. But it's quite interesting how these things open up. Note that generally Bitcoin dominance rises when the market is bearish. This is kind of the tried and trusted. When you get a bit of upside, things close back together, a bit more speculation climbs in. And a lot of this, by the way, is driven by bot trading and algorithms and all that kind of stuff. So there's a reason why this kind of ebbs and flows, but it's really showing market structure more so than, these traders don't particularly care about which asset it is. They just want to trade for fiat, right? A lot of these futures are trading on that basis. Fairly substantial burst of volume. I mean, just if we take all curses away, you can see this burst of volume on this rally it's a bit of a wake-up call, right? And it was coming from multi-year lows. Kind of comes back to the low volatility, creates high volatility type behavior. Here we are was an even more interesting chart. So that previous one we looked at was open interest dominance. This is trading volume dominance. And when I was talking about liquidity, this is going to do a really good job at showing that. We're essentially at a point in time now where the market is trading. And I would almost go so far as to say that the market, and there would be algorithms out there that when condition A, B, and C are hit, put on 50%, put on X amount of leverage for Bitcoin, X amount of leverage for ETH. They would have all these calculations to say, during times when Bitcoin has X%, then Ethereum normally performs by Y. Based on a risk-adjusted basis, we'll put 35% leverage here and, 45% leverage over there. All this stuff is getting baked into algorithms. And what you're seeing is the market is now trading these assets essentially one and the same, which is kind of an interesting dynamic, but it really does show that we're getting this convergence, right? Where the market's just taking what the liquidity is now sufficient on both of these assets for, let's call it cross margin positions and all these types of things to get put on. Strategies where they'll short Bitcoin and long ETH and take the spread of the alpha performance and all that kind of stuff. There will be all these kind of interesting dynamics, but here you can really see it playing out in the data. I mean, this convergence over the last 24 months is quite intriguing to see. Right, now onto the liquidation side of things. Now this is kind of interesting. Actually, let's go on a 3-month basis for both of these. So there is no question that there was a short squeeze that triggered a lot of this stuff, and you can see how offside the market was. Right, so these big short squeezes, I did the calc the other day. This is about 450 million, if I remember correctly, in total. So you can see down here, this was about $200 million in a day, or 160 million. Maybe my 450 was a bit big. I think this was 100 and this was also 65. But you can see that short squeezes really were a big motivator for pushing the market higher. And you can see this for both BTC and ETH. Note that the ETH shorts actually got kicked in a little bit later. Bitcoin really started this rally. So just coming back and really just assessing things from a market structure perspective, based on all the data and the market structure that I tend to see, I still see that Bitcoin leads these things. We typically see that the market will move off a Bitcoin related move, and Ethereum will then be kind of the bellwether that follows it coming after that. So we can see here that the short squeeze here on the 16th of January was during that rally. And what happened is that the Ethereum price essentially had to get to a higher level to actually initiate that short squeeze. So this is kind of showing that those algorithm traders are following each other through the market cycle. They typically use Bitcoin as the bellwether. And you see this kind of sequential, well, in this instance, short squeeze that started to play out. Now, naturally, there's a bit more volume on the long side as well, right? You're going to start getting people who try to long the dip here. I don't really know how you get liquidated as a long over the last month. It feels like it's been up only, but people find ways to do these things. It's quite remarkable. So this is a cool metric that I've been spending a bit more time with. I quite like these oscillators it's taking, whether it's relative profit and loss ratio, or in this case, long liquidation dominance. They're really powerful, especially on something like I've got a 7-day moving average here, just to kind of smooth things out. But you can see the scale to which this short squeeze actually played out. It shows you how offside everyone was betting that Bitcoin was going to 10K down here, and you can see how significant, massive dominance. This is saying that something like 87% of all liquidations that day. And considering it's an up only candle, how on earth you get liquidated in a long position here is beyond me. But anyway, this particular day, we had 87% short liquidation dominance, which, as you can see, this is the full history that we have. It leaves everything else in the dust. Even the FTX blowing up didn't have anything quite close to this, right? There's about 10 percentage points off what we see down the bottom here. So really, it shows that the market didn't expect this rally. Although, kind of interestingly, when we're looking at a lot of the data about the amount of capitulation that happened, I don't know why anyone was too surprised that up was certainly an option here. And you can see here, this is our futures open interest daily change. So 1 day change in open interest. Typically, obviously when you get upside, when it's positive, that's essentially showing that you've got people adding leverage to the system. Downside is obviously liquidations or people closing out. So it doesn't just consider liquidations. It also looks at people just closing out their positions. And it doesn't care about long or short. This is just open interest getting closed out. And you can see that our candle here is on par with, this is back here in May 2021. This is in the December sell-off, which really, in my view, was kind of the start of the 2022 bear, even though it was in 2021. Here's FTX. In fact, Luna and 3 Arrows weren't even this big. And this one here, it shows you this was a significant event. So alongside many indicators, there was a lot of momentum, a lot of volume, a lot of this rally is different. It has different characteristics, different properties. I think psychologically it's different. From a market structure perspective, it's different. If there's any chance that we've probably put a bottom in, there's a lot of signals saying that this rally is essentially giving us a bit of confirmation to that. I still think it's probably going to be a 12, 18 month ride between here and any kind of, hey, look, it's a bull market. But at the very least, I think there's a lot of evidence to say that at least for the short term, maybe even medium term, we probably do have a pretty significant low that's been put in. And there's lots of data suggesting that, at least in my book. I mentioned before we were looking at things in terms of BTC and ETH denomination. This is just looking at futures markets in perpetual and all futures markets. And what we're doing here is comparing, there's 2 different types of leverage ratios. The ones you can see here are comparing the amount of futures open interest in perpetuals in purple and the total futures market in orange to the market cap. So up here, we're at 2.5% for perpetual swaps. That means that if you look at the Bitcoin market cap, whatever it is, 500 billion or 450 billion, 5% of that, 2.5% of that is the size of the open interest in perpetual swap markets. And for futures markets in general, that includes calendar futures, about 3.4%. So that's comparing it to the size of the Bitcoin market cap. Now, I've also got here in green, which you can see is a very, very similar shape. This is a estimated leverage ratio, but it's essentially using the amount of open interest on the exchanges relative to the balance of coins on that exchange. So it's kind of a microcosm, so to speak. The orange and the purple curves are kind of a global, how much leverage is there relative to the size of Bitcoin itself. And the green curve is how much leverage is on each exchange relative to the size of the exchange. So it's a bit of a microcosm. But really, the big takeaway here is that FTX really washed out a stack of leverage. There is a lot less leverage in the system than there was pre-FTX, and that's not a bad thing. And there's a lot of indicators as to why I believe that we are in a spot-driven market. I think spot is playing a much more important role right now. I think the demand for spot is much higher than people expect. I think we also have a bit of PTSD where we had so many leverage flush outs through the last, let's call it 24 months, that people aren't accustomed to seeing a spot market. But that's really where I think that our edge is going to exist, where we can look at this from both a spot and a derivative basis and really make some strong decisions based on that. So with that as context, just reintroducing here, let me turn off my formula and we'll come back to that. Now that we've got a bit of a picture of the derivatives markets, we've seen a bit of a flush out. We've also seen that we saw a short squeeze. And I mentioned at the start that it's highly probable the more the price goes up, the more people get excited. The more people get excited, the more leverage they take on. And the more leverage they take on, the more likely we're going to get a long squeeze at some point in time. At some point, this rally is going to have a pullback. We're currently in the process of, I guess you would call this a pullback. We're at 22,845 according to my block clock, which is sitting here in front of me. I don't know if this is the pullback. I wouldn't be surprised if we actually get another leg up to maybe 25 and then we get a pullback. But at some point in time, people are going to get too much leverage and too excited, and we'll flush out to the downside, and we'll have another 3 or 4 month miniature bear market. So what we can see here is that we have positive. We went into backwardation across both calendar futures in blue. Perpetual swaps are in blue and the calendar futures in orange. And what we can basically see is that this is the market was basically betting that in the future, Bitcoin is going to be worth less than it is now. Very, very uncommon to see backwardation. FTX and May, June, July, and all of those preceded some significant upside. This is typical. Even back in the days of BitMEX, this was actually the case. So now that we're in a bit of positive territory, the market's starting to get a bit of a whiff that maybe there's a bit more momentum. And as you can see, we typically, during a proper bullish impulse, get quite a bit higher than that. This is yields on the perps, 22%. On the calendar futures, 11%. Up here at the all-time high, we're at 22%, 16%. Where we are at the moment, we're at 7.5 and 3.2. So we're not exactly in full moon boy territory yet, which again tells me that there's probably some juice still left in this rally, especially considering how much spot dictated what's happened over the last, I would go so far as to say, 6 months. Now, bringing back my little formula, we discussed this the other day, which is how spot and derivatives actually speak to each other quite a bit. So the overlay that you have here is the entity adjusted SOPR, or the entity adjusted realized profit multiple -1. Bring it down so it's on the same axis. I can plot it between 0 and 1. But I don't know about you, but there's something pretty similar between these charts. When there's a bunch of speculation going on in the futures market, there's also a bunch of guys selling for a profit. Interestingly, SOPR nicely picked up these low points following 3 arrows. We didn't see it show up in futures markets, but man, did we see it show up in our spot markets. Same here. We saw a bit of speculation, but people were taking profits. SOPR came back up to a retest of 1, set our nice little local high, 24,400, which then really preceded the FTX event. So you can see that we actually have positive momentum across all these things. But this is one of the most fascinating things, to be quite honest. What you see on the chart right now is one of the more interesting things I've seen in some time. And I also haven't seen anyone talking about it. To me, what this is showing is that spot behaves in a very, very similar manner to our futures and derivatives markets, aka the human beings trading this thing, whether spot or derivatives are doing the same damn thing. So we can actually use this information in conjunction and really track these things. So I'm really excited to put this to the test over the course of this next, well, let's not call it a bull market just yet, but whatever the hell is in front of us. I'm excited to be using all of these tools and kind of bringing together the derivative space, the on-chain space, and really studying this thing from several angles. I think there's a lot to be garnered from that. And yeah, it's going to be fun to actually explore this and check this out in detail. But we do have some positive action. It's not exactly bull market territory for either the spot or the on-chain space. So as such, if I was to hazard a guess, I would not be surprised if we had a little bit more of this leg to go. I really would not be surprised if this thing gets a little bit more juice to the upside. You can see here the scale of our SOPR is not even close to what we had back here in 2019. Let me just turn this off and that one there. And let me just stick this onto a bar chart so we can see it in scale. So here, that's the amount of positivity that we have in our current rally. That's the micro rally we had in 2019, which, by the way, off the same level, if you do the same percentage gain, this thing takes us back to all-time high. So, you know, we're not even close to the level of like exuberance, let's call it, of a micro rally. So again, I do think there's probably still some gas in this tank, but you know, we'll see how it plays out. Anyway, hopefully that's a useful little overview, and I will see you in the next one. Cheers.